Hi, my name is Jordan Wilson. We'll continue our look at the investor profile today with a focus on the investor's risk tolerance. And that obviously plays a huge role in the asset allocation and the specific investments that an investor makes. Your risk appetite is based on a few factors. At the top, we have visceral versus rational. Visceral is your gut feelings, your emotions. That less logical side of the equation, and even though it's less logical, it has a huge impact on the investments you make and the strategies that you pursue. Now, our objective over time should hopefully to become more rational, take the emotion out of the equation, become more objective, more unbiased, and focus on the important factors in creating portfolios that work for you and less on the emotional areas or the fears that you have. And there's nothing wrong with emotions or fears, but if you don't understand how they come into play, then they may lead you on the wrong path. The second aspect of, say, one's risk appetite is the return aspect, the risk-return relationship. When you invest, if you're not investing in a risk-free asset, you have to assume some investment risk, and so you require a risk premium. If you better understand the risk-return relationship, then you can better assess what sort of premiums you need to take on additional risk and how they interrelate again in a portfolio. Time, funding also play a part in one's risk. The more time you have, the greater the ability to handle increased volatility. That is risk. The less time you have, the greater need for safety, liquidity. You want to preserve your assets. You want to have the money when you need it. And the funding aspect, the greater that your funding ability is, the less risk that you have to take on. The lower the amount of capital that you can invest, that may require you to take on added risk in order to chase greater return to achieve your financial objectives over time. We went through this specific slide in a previous session when we looked at investor constraints. So I'm not going to go through it again, but you can just sort of see the relationship between time, funding, and risk. The longer that you wait to get started on investing is the less time that you have to achieve your objectives. And that may be 5 years out for a house. It may be 45 years out for retirement. But for every year that you delay, that's 1 year off your time horizon. And really the only way you can counter that is by taking on increased risk in your portfolio or increase your periodic funding. And as we saw when we went through this in some detail, there's probably a cap on the amount of risk you can add to your portfolio or the amount of funding that you can make to catch up. So there's that interrelationship, the amount of time you have, the amount of funding or capital to invest should play a part in the amount of risk that you assume in your portfolio. What did I mean about visceral? Yes, emotions. Yes, gut feelings. But what does that actually mean? Now, some investors, to them, risk is the fear of losing their money, losing their capital. For some investors, that may be the invested capital, so the money that they contributed from their own genes into the portfolio. Other investors may include losses on previous gains. So if you invested $10,000 in a portfolio and over 3 years it grew to $15,000, some investors might only be upset once we hit $9,000 because we lost $1,000 on the initial investment. And then others may be upset if we're suddenly at $14,000 or $13,000 because we'd hit sort of a milestone and now we're reversing course. So that's sort of the realized losses on past gains. And then others, I bought Bitcoin for $300 and it's trading at 20,000. In their mind, they think that that's a realized gain. And if it falls to 15,000, they've lost. But in reality, they're still up a lot of money. So some people, okay, the stock hit a certain price, anything below that, I fear loss. Whereas others would say, no, I only put in $1,000, it's now trading at 10, even though it was 15 a week before, I'm still up. So some people have different views on that. Now, if you're afraid of losing capital, then you want to focus on low risk, low return investments. You want the security, you want the liquidity, and that's fine. Other people, the fear of the unknown, unfamiliarity, that's a risk to them. And usually that comes from lack of knowledge or experience. And the example I cite here would be call options. Now, if I go to write an uncovered call option, in theory, I can have unlimited losses on that. It is a high risk proposition. However, if I write a covered call option, for many investors, they actually use that, let's use the term hedge, not probably technically correct, but to sort of lock in their profits. So it's a useful vehicle to help manage your risk. Yet, because it's an unfamiliar investment for many people, they see it as risky. The third item I have on the sheet is the once bitten, twice shy fear factor. And that's the fear of repeating past losses. To these investors, the past is prologue. And what I mean about that is, in 2012, you bought gold, let's say at $1,600 per ounce. The investment fell over time. 2015, you finally got sick of it, sold it for $1,100. You lost $500 an ounce on your investment over 3 years. Not happy. Gold, terrible investment. 2017, 2018 rolls around. You start reading in the papers, watching CNBC, and you see that gold has been recommended as a great mid to long-term investment. However, based on your prior experience losing money on the gold, people in this bracket would not want to reinvest because they were burnt once before and they have a bad memory of that. And if we use that burn analogy, that's like the child touching the hot stove. They remember that. But the reality is that what's past doesn't really impact directly what's future. So just because you lost money on something previously doesn't necessarily mean that you'll lose money on it again. And I'll flesh that out in a couple of minutes. The flip side of the once bitten, twice shy is the investor with the huge positive risk appetite who, if they've lost money on an investment in the past, it's payback. They're due. Karma. They lost before, now it's their time to shine again. And I do see that. So again, from both sides, if you're risk averse, there's a fear factor. Other people use it as motivation to jump back on the horse. A big one with people is not following the crowd, taking contrary positions. At some level, it's the fear that you know nothing. I mean, really, you're a doctor, you're a lawyer, you're a nurse, you're a teacher. That's your area of expertise. What do you know compared to a talking head financial expert on television? So if you want to run contrary to that, if you don't want to take the herd mentality, that can be stressful. It's also comforting to follow the experts in the sense that if you're right, great, they confirmed your investment decision. That's confirmation bias. But even if you got the investment wrong, if both you and the experts were wrong, that's also comforting because, hey, I got it wrong, but all these talking heads that do this for their day-to-day livelihood, they also got it wrong. So it wasn't a bad decision by me, it was just bad circumstances. So very comforting to follow the herd. One of the problems with following the herd is that's a prime reason for investment bubbles. So you do have to be a little bit careful with that. And my last comment on that is, given that this is my area of relative expertise, and I do follow a lot of the talking heads and the investment advice and the media, they tend not to be correct most of the time. So I'm not sure, at least in my instance, that following them would make me any more comfortable. In fact, it probably would make me more stressful if I was in agreement with them on many things. Past is prologue again. When we look at risk from a historic basis, many investors say this investment, this asset was risky in the past, therefore it's risky today, and it will be risky in the future. Perhaps. When we calculated standard deviation, one of the factors that we included in the calculations would be historic results. So history is indeed utilized to assess or extrapolate into the future to some extent. But we also looked at expected returns. We looked at modeling of future. We looked at changes. Maybe a patent on a product expired. Maybe Apple Computer moved in as a direct competitor, a la the Sony Walkman, or versus Nokia cell phones. Just because a company did well in the past, or maybe not so well in the past, isn't necessarily a guarantee of future results. So you always have to look at, where are we today? What is the economic situation? What is the competition? What new factors does the company bring to the table that may break that historic result? So you assess everything on a pro forma going forward basis. And that's also, as an aside, why every mutual fund prospectus that you will ever look at has in some form or other, past performance is no indicator of future results, because the past isn't a guarantee of the future. The past is not necessarily prologue. When you're dealing with an investment advisor or many people on their own, usually fill out risk questionnaires. as a way to sort of assess what level of risk you might have. I think I use something that's about a 12 different boxes, let's put it that way. And depending on where you come out from the risk questionnaire, you might be conservative, you might be moderately aggressive, you might be highly aggressive. And that helps determine what target asset allocation and what strategies should be pursued. But again, that's just, for me anyways, a starting point to help lay the groundwork for the risk assessment, because I'm not a huge fan of clamping people into boxes. The other thing that you'll see out there are risk profiles. And the one I have listed here is Bailard, Biehl, and Kaiser Five-Way Model. And I just want to go through that quickly, hopefully quickly, so that we can sort of see what that is all about. The psychographics models, the investor profiles. So these also help determine one's risk profile. And the Bailard Five-Way Model, it starts out with guardians. They're extremely cautious, they're anxious, they're risk averse. They want to preserve their capital. Often older investors who may have a perfectly reasonable view of why they want to go that route, because many older investors do want and do need to preserve capital, and they are willing to sacrifice return in order to have less risk. But you also see it with new investors, those who lack knowledge, lack experience in investing. And that's what we just talked about. The lack of familiarity creates the concept of risk. For these people in the Guardian class, government bonds, T-bills, balanced mutual funds, lower risk vehicles that sacrifice return for safety. Next box, celebrities. They're anxious investors, like the Guardians, but they're impetuous. You'll usually see a crowd mentality with them. They like to invest in the latest hot investment fads. It can be any age group, though it tends probably more to be less experienced. The more experience you get, the more you realize that this is probably the worst box to be in and the least successful. And so with that lack of success, they tend to migrate into other boxes. You tend to see haphazard portfolios, things that are just thrown together with no thought as to how each investment relates with others. The one commonality you will see is that there tends not to be plain vanilla assets. When I'm at my cocktail party on a Saturday night, I don't really want to be discussing Dow Jones diamonds or spiders from the S&P 500, the plain vanilla index funds. I want to discuss Albanian high tech. I want to discuss Bitcoin. I want to discuss, as I record this, GameStop. I want to discuss Tesla. I want to discuss sexy things at the water cooler on Monday morning. I don't want to discuss bond ladders or index funds. Adventurers, highly confident people, but they're also impetuous to some degree. Often they're entrepreneurs, strong-willed people. The big concern with this group to me, and I see this in other areas as well, is you have success in one area of your life, in this case business for the entrepreneurs, so they expect to have that same success in other areas. And it's interesting because they often forget the amount of work they put into running a business. And it probably requires the same amount of work to be a successful investor. Yet there's that sort of, oh, I'm good in this area, I should be good in this other area. They tend to maybe avoid diversified portfolios. They prefer taking on a little bit more risk. They like riskier assets. Again, the plain cookie cutter index fund portfolios, a little too dull for them. Individual, yes. Also strong-willed, also highly confident, but they're less impetuous. They act with care. They tend to be more rational, analytic, and objective in their approach than the adventurers. They understand, or they take the time to understand, the risk-return relationship. They tend to be more contrarian. They have an eye for value. And because of that, they tend to be better at avoiding investment bubbles, the herd mentality aspect, the follow the crowds, that kind of stuff. They're more do-it-yourself investors. And they do understand, appreciate, and utilize well-diversified portfolios. So that's not a bad box to be in if you're trying to figure out where you want to slot yourself. The final box is the straight arrows. That's an average investor. And the problem with a lot of these models, including the Bailard Biehl, is that models tend to create extreme boxes. You're in here, you're a widow or orphan on the left side of the risk spectrum. You're a wolf of Wall Street on the right-hand side. You're a guardian, you're an adventurer, you're an individualist. And the reality is that people may lean one way or other, but most people don't clearly fall in one box. And that's the straight arrow here. They're the average. They have some experience, some investing skills. They overlap between all the categories. Some are more interested in preservation of capital, but not to the extreme perhaps of the guardians. Others understand the risk-return relationship, but maybe they're not as strong-willed or confident as the individualists. And they can also be like celebrities. Maybe not as chasing the current fad, but they can be reckless. The one thing you'll see with straight arrows is because they do understand a bit about the investment process, and they do have some confidence, and they do want to act appropriately. They're the ones that are probably the most likely to seek out professional advisors to work with, to fill in the gaps that they need. Then the final box is just, where do you think you fit into the equations? Are you a guardian? Are you a celebrity? Are you an adventurer? Are you an individualist? And I think if you look sort of with an open mind on where you might fit in, and you look at the pros and cons of that box, and then you look at the other box and say, okay, here's where I am today. Where might I want to be? Where would make me a better investor? And then you can help address deficiencies and move from box to box. Now, our goal is to become rational. We looked at investor objectives and constraints in a previous session. There's different objectives, different constraints if you're 30 years old versus if you're 70 years old. There's also different objectives and constraints between two 65-year-old couples. The one couple that has ample resources, and their objectives are philanthropy, estate planning. Who will be their heirs? Who will they give their money to upon death? They want security. They want safety. Versus another 65-year-old couple that maybe doesn't have that same level of wealth, and they need to take on slightly more risk to bridge that gap between their pension income, cash flow, and what they actually need to live on a monthly basis. So again, you can be the same age, but vastly different objectives, vastly different constraints. Becoming more rational means better quantification of the risk. We previously looked at standard deviation being a classic quantified measure of asset risk, assessing the volatility in the expected returns of an investment. How risk is both upside, not just potential loss. And we looked at risk-return efficiency ratios like Sharpe, Sortino. We also discussed systematic and non-systematic risk. Systematic is a risk that affects the entire market or a market segment. The prime interest rate. It's thrust down on you from above, whether you're a business or an individual. The non-systematic risks are specific to the asset or the company. You can impact your personal credit rating or your company's credit rating, and that will impact relative to prime how much it costs you to borrow money. But you can't impact prime. So if prime is 3% and you're a very good credit risk, maybe you can get prime or prime plus 0.25. If you're a poor credit risk, maybe it's prime plus 2. So you can't impact the systematic risk, the prime, but you can impact the non-systematic risk factors. Diversification. We'll look at that shortly. That's managing your portfolio risk. If you recall, non-systematic risk is also known as diversifiable risk. So we'll look at how assets can be matched together in a portfolio, and based on their asset correlations, we can reduce portfolio risk by adding low correlated assets. So that's sort of more of a rational look at risk. Again, our goal over time is to just move from that visceral emotional side, the fear of loss, unfamiliarity, past loss, etc., to the more logical. What is risk? How does risk fit into my portfolio? What is asset correlations? What is the relative risk in different asset classes, but also subclasses? Because a risk can differ wildly in a subclass. Equities. Big difference in risk between a blue chip mega cap company, Coca-Cola, for example, versus a micro cap junior mining company in Western Canada or Eastern Africa. Both are equities, vastly different. Venezuelan bonds, government bonds, versus US bonds, both government, vastly different risks. And that's kind of where we'll move to next, is look at portfolio diversification. That's it for today. And that gives you something to think about as to where you sit as far as your risk tolerance goes, and maybe where you'd like to move to over time by gaining a little bit more education, a little bit more experience, and a little bit more understanding of the concept of risk return. So thanks for your time, and have yourself a good day.